if we now dig even deeper into the Enigma principles and are completely wiring ourselves into the mind of Enigma, we have to understand a lot of basic principles about the market on top of the who, the what, the where, the when, the why, and the how as well. We have to understand of how the market really works. And we have to understand that nothing in the market is ever random. Nothing ever. Again, every single push has its deep purpose. It has to have its deep purpose. Again, you have to really think. Every single move in the market brings in buyers, takes out maybe sellers, gives reason to other strategies. This AI or what this algo fired a position here, that whatever had its where of the price action. It happened in a specific zone, also in a specific session time, the why they do stuff, the how with the emotions or the why with the emotions, and the how, for example, with all the strategies, the equal, everything, every single thing has its reason inside the market. And that's the difference of you being a highly advanced trader or an average trader. If you really understand this little aspects in here, that every push has its consequence. Every single push costs billions of dollars. They do. Right? So of course it has its consequence. It's always cause and effect. If they do X, Y, Z, it will do X, Y, Z. Right? Again, if they take a Koch or show a Koch, that has its consequence. But it costs them a fuckload of money to do that. Right? So of course they will make something out of that. Every confirmation or confluence of a specific method brings in liquidity, even the most random shit. Again, a normal stuff like this, boom, support and resistance brings in people. There's people buying here. You have to understand that. That's probably also a Fibonacci retracement of the 61.8 or whatever. That's all stuff you have to keep in mind. That's all the reasons they have to show non-fucking stop. There's hundreds of thousands of different strategies and they all have to be fulfilled. Again, we came to this, or myself, I came to this conclusion, I don't know how many years it is ago, like almost a decade, when I programmed that shit. I programmed normal retail strategies. And guess what? If you take anything like a normal Fibonacci retracement of the 61.8 with a 1-to-1 risk reward, you will have a freaking 50% winning rate. If you take a support turns into resist or even support levels and you want to trade away from that with a sell entry and here stop goes above you, a 1-to-1, you will have a 50% win rate. If you trade a trend line, whatever, third touch, with a 1-to-1, you will have a 50% win rate. It doesn't matter what you do in the market, you will have a 50% win rate if you stick to normal strategies. Same thing with smart money concepts. Obviously, that's the funny thing now. When you trade a 1-to-5, they will give you so many examples that will work that it is a 1-to-5, obviously. But then, of course, 4 other ones will fail. So you're still ending up a break even. And we tested that all. We programmed these smart money trap zones, or not just smart money trap zones, but these mitigation zones and all that stuff. So you have to stick to intention trading and move away from that false belief system of the market works with technical analysis. You have to identify the technical analysis in combination with all those reasons and then take your trade. And then your probability is obviously way, way higher and much more increased if you sticking to this normal approaches that everyone shows you, right? Or can we show you the stuff which no one shows you? Because again, they think smart money drives price. It's not, right? Smart money is just engineered in price as well. Of course, a smart money zone will work from time to time, but of course will fail a lot of times as well. So always keep that in mind. That also bots and all these AIs and technologies they're literally flooding the market and they never ever miss an opportunity. That's why they can't even make one mistake, because bots are all everywhere. They're all over the place, right? Again, hedge funds, all these institutions, they spend, or even banks, they spend billions of developing all these AI services or market scanning methods and automated trading possibilities. Billions every single year just to automate the stuff. So of course, Enigma has to be efficient about what they do. They obviously always balance liquidity, builds it up, gives even the AIs and the EAs reasons to take trade just to then take them out. Again, we tested that all with multiple different strategies. It's always the same. It's actually insane of how Enigma does develop and engineer the market. It's insane. So you have to understand that and then to truly understand what they're doing. Okay. So the biggest form of liquidity is market structure. Again, it's the first thing someone learns on baby pips or wherever is higher highs, right? On lower lows out of a sudden. That's the Koch. That's another break of structure. Oh, here's another Koch. Here's another break of structure. Blah, blah, blah. All that's like the most efficient form of bringing in liquidity because that drives direction for most people in this market. So always pay attention to this break of structures and Kochs in your favor in terms of opposite direction of the retailers. Yes, we have the relevant break of structure, but when does the relevant break of structure come in? After we had all the other reasons. We had the who, the what, the where, the when, the why, and the how. And obviously then, only then if we have all those reasons, build up, boom, inducement with speed, in London Open, for example, now you can look for the relevant break of structure, and boom. Where is that also? To the left, took out maybe medium inducement here, fakes the smart money trap in here, vector candles, timing window, relevant break of structure, let here, EDM here, boom. You see, it's much more confirmed, and we also add all these reasons into the whole thing, right? So we don't randomly just take these Kochs or whatever. Definitely not. Timing is, again, we spoke about a lot of times, your overall compass. If you just look at the timing, again, Enigma has to deliver price action with timing as well. Session opens. That's where literally billions enter the market. Boom. London opens, the most liquidity comes into the day, the whole of the whole day is in London Open. Second one is New York. But New York acts differently than London. London Open usually is a trap itself. New York Open is not the trap. New York Open brings in the liquidity. New York trap 1 hour after. Use the compass. Use the magic manipulation minutes to understand the London moves. And then combine everything with the LETs and EDMs and with all the other reasons, the build up, the inducement, the mitigation, and so on and so forth, right? But also the who, the what, the where, the when, the why, and the how. Zones of liquidity will be targeted and have to be targeted. Day open price, Asia high, Asia low, Asia midline, yesterday high, yesterday low, weekly highs, weekly lows, session open timings, a lot of times as well, right? Overall, these inducement zones, they have to get targeted because that's where the major liquidity is. And at the end of the day, Enigma also has to balance their books out as well in terms of the mitigation for their books. They have to fill the imbalances. Again, the quote unquote fairly have to deliver price to get every price point a second time and not leaving gaps in. So always keep these principles in mind. And if you just only monitor those areas with time, with the intentions, with the entry helper, you're having the most advantage you can ever have as a trader. Just use the whole thing, use it, but it goes much deeper than that. Principle, again, of imbalance, talked about it, they have to fairly deliver price action, use it in your advantage. Points of interest are much more confirmed if there's an imbalance, right? Principle of equilibrium. Again, the biggest hedge fund in the industry, or not the biggest, but one of the most successful ones, was Renaissance Technologies under Jim Simons, right? That's where we have our entry helper approach from with the equilibrium touch, when we have price line, right, with the on entry helper, and the equilibrium line. When it shows these let entries, the liquid equilibrium touches, that is when price comes back to the equilibrium, right? It gives you a huge advantage. Use it, right? Same thing for the fixed equilibrium, which is the static 50 or equilibrium, right? Also use that in your advantage if there's no potential let. Let's say the equilibrium line is down there, but price makes like this. Boom. Okay. If that's the fixed one, static, it's also possible, right? Again, it's technically coming back to the equilibrium, but obviously the equilibrium moves. That's why we made the liquid equilibrium, right? Because price moves, so has to be the equilibrium, right? Equilibrium is just the middle point, right? It has to sometimes, or not sometimes, but most of the times, do exactly that, to come back to the equilibrium and then move away. Again, that's not something we made up. We got that from literally one of the best performing hedge funds in the industry. We just used a very simple approach for us, programmed the whole thing for you so you can visually see it much more easier with the let. But then we've made the lets way more accurate and even said, okay, only wait for the build-up being induced, wait for relevant break of structure, for example, and then take your imbalance zone, point of interest, mitigation of the inducement. And if you have that, and that's also, for example, your let in here, right? Boom, then take it. You see, we much more confirm it over and over and over and over again. That's why it's so efficient, right? So use that always to your advantage. The principle of inducements. First of all, you have the principle of build-ups. People and systems need reasons to get involved in the market. What does it mean? Think about anyone. Anyone who's a trader, why would they open up a position? They just don't randomly think like, oh, let me lose 1,000 euros today. Or no, they will not do that. Let me risk 1,000 euros today because I learned this in the strategy. I think that's the third touch of the trend line. Okay, whatever. I learned that from XYZ. I saw that 50 times working out, even 50 times not working out, but give it a chance, 50% probability. I'm willing to risk 50%, 1,000 euros on this trade, for example, right? Even if they know it only has a 50% probability, but they do it because they have the reason and they think, oh, okay, third touch of the trend line, but they need that reason. If they don't have this reason, no one ever will just place a random buy. Even these breakout trades, they're all having their reasons, right? So your task is to identify all these reasons, what people do, and then don't do that and wait for them to getting induced into the market and then wait until their stops. Again, if you understand this is a trend and people buying here, you could not care less, right? Even if they're getting the reaction, you should understand if they're in build-up now getting induced to the high side, they all obviously jumping in the bandwagon, right? Because they're seeing the momentum, the speed, the vector candles, they're all getting excited. Awesome. They're all jumping in buy. They're all having the direction buy long, right? That's why you know, okay, now it's slowly sure time to reverse the market. And that's your trading opportunity in here. Away from the inducement, away from all the retailers. And obviously the best entries are always those who no retailer has a confirmation. That's why you see me doing market execution so many times and not limit orders. Because again, a lot of times, you saw it a lot of times as well, for example, have a picture perfect inducement here and then price just drops. Never gives the relevant break of structure into mitigation, whatever. It never comes. That's like the truth, the harsh truth about it. That's how you have at some point learn how to take this trades as well, but you only can learn that if you understand really what's going on with the who, the what, the where, the when, the why, the how, in combination with everything you learned before, with the cycles, daily cycles, what's going on to the left, what's the overall picture, and what you expect in terms of cycle variations, what intentions they overall show. The principle of inducements to take out liquidity is also an interesting one. Of course, inducements not only takes people out, it also brings people in. So see the both sides of the inducement, but obviously then you have to use it what makes sense. Again, talked about it like 500 times already. triple top in here, this inducement doesn't only stop out these resistance traders, right? That also brings in breakout traders and obviously gives the illusion that the market is trending and now makes a new high. And obviously then it can drop, right? So always see both sides of the inducement and know the principle of the inducement, that it takes out liquidity, but also brings in liquidity, right? So the principle of tick cost, we talked about that a little bit earlier. Every tick costs millions. Nobody knows the exact amount of how much a tick or pip costs, but obviously if we have $1 trillion a day market, right, obviously you can just calculate a little bit out what one tick has to be worth, right? So again, if they show a normal push like this, there's literally billions in this push on Euro USD, for example, if it's that's the 15-minute, for example, right? There's billions inside in there. So again, every tick costs money to move the price. And if they now create this koch, this is very, very expensive. So that's why they want to obviously drive price again higher most of the times, again, not giving people the reason, because they taking their liquidity. If everyone sells, they can't bank a profit. They obviously want to buy when other people sell. They're taking the opposite direction. They're technically a huge B-book broker. B-book broker just is a broker which takes the opposite side of your trade. Why does brokers do that? And then even these brokers teach you free webinars when they teach you strategies. What freaking hell is going on there? Question the system. Same thing with Enigma overall, right? They taking the opposite side of people's trades. That's just the half truth of it. That's why they making trillions and normal people don't, right? Because they engineer the liquidity. They show the false reasons. They take you out. And then obviously no one has the opportunity to jump in, and then they move the market in the opposite direction. How many times have you seen that? But nobody can fucking enter those cells because there's no break and retest into the belt. It's not there, right? So that's how you have to understand. The more you deeper involve how the market really works, and that's when nobody has an opportunity. That's the most efficient price movements, because they driving price and you just sit there, right? Again, your 100 lot does not make a difference to them. It doesn't. Zero. Right? But they obviously take all the strategies in combination, and all of a sudden it's millions and billions of lot sizes. Right? It just has to be like that. And it is like that. Right? Again, millions of people see the same Euro USD chart at the same exact moment as you. It's not you taking the trade. It's not you getting stopped out. No, it's the overall structure. It's the overall strategies. Millions of other people and hundreds of thousands of other strategies. It's always the same. Okay. Principle of cheap and expensive ticks. Right? We talked about it. If you're like in a range, it doesn't take them too much cost to develop price action in here. But guess what? A whipsaw takes them a lot. That's why a whipsaw usually whips it again, because they want to make the money back that they just brought in here, right? And then boom, not giving any people the chance to get into trades again, just whip them out, get the money back. It's always balanced, expensive, and cheap tick costs. So when they build cheap liquidity, it's easier for them to drive price, obviously. And if it's an expensive tick cost or like price movement, aka like a koch or a huge zone getting taken out, whatever, that's expensive for them. That's why they want to make the money back, obviously. Then principle of fake reaction, right? Liquidity enters specific zones, naturally price moves, obviously, right? And they want that to happen, obviously, to even make or let people do the work for them, right? If they having a false smart money zone in here, they're jumping in, drives price lower. Perfect. Why would they stop that? They obviously want fake reactions to happen. So people jumping in here, when it comes back even here, and then obviously stop them out. Boom. But they obviously want these fake reactions. They want obviously people trading double bottoms. They want people trading trend lines. They want people to create support resistance and smart money concepts and all that stuff. They want that because, again, people need the reasons, they need to see the reaction, and they have to see price action react at some times, and it has to work at some point as well. We talked about that in week 1 already. Stalin principle, they have to feed the fishies, and if they just stop them out all the time instantly, no one would ever trade these strategies. So that's why 50% of the time every strategy will work, no doubt about that. Every single strategy. And if you now come up with a magic trend line, you just throw in from point A to 1B randomly in the chart, and then say if price react from this zone, I will trade a trade with a 1-to-1 risk reward. You will be surprised. You will get a 50% win rate. It's a freaking promise. You can test it out right away. Throw a random freaking chart in a line, in a line in the chart, and you will see the price will react from that zone. It's, again, I think we even did this experiment in the week 1 as well. It's just how market works. It has to engineer market like that every freaking weird strategy will work 50% of the time on a 1-to-1 risk reward ratio. That's why, again, you dig into intentions and see what's really going on. The last one, and the last principles is in here, is the principle of payback. Right? They take the opposite side of positions and they push price in the opposite direction of 90% of traders, and they will make their investment back. Again, they will not waste millions and billions, or sometimes even trillions, to build up liquidity and take other people's opposite direction side. No, they obviously will get their payback and take other people out. The other thing is the monopoly principle. And that's why people be like, oh, how can they do that? How can they manipulate all the stuff? Blah, blah, blah. Monopoly principle means the bank never runs out of money. If you look at the game of Monopoly, in the rule set, it even says, oh, what happens if the bank runs out of money? Rule number 1 is the bank never runs out of money. If you look at this game, it even says, oh, if for some whatever reason they handed out all the money of the game, then guess what? Take a piece of paper and write a 100 on this piece of paper, and out of a sudden you have a new 100 bill. It doesn't matter. Just write on a piece of paper how much more money people still get or like have. The bank never runs out of money. In this case, it's the Fed, it's the higher forces, whoever it is, nobody knows, but obviously they driving price. They print money. We talked about it also in week 1, that they can do whatever they want. If you control the money, they can drive price however they want. Obviously, they have limits like daily ranges, right? They can only move price at one day at a specific range. They can't move in one day like 500 million pips. That's not how it works. They only do the same thing every single day to make it efficient. They have to keep the wheel spinning. They only have the cycle variations. They have the build-ups. They have the inducement. They have the structure breaks. They have the mitigations. They have timings. They have all the zones overall. They have the liquidity zones, and that's all the limits they have. That's it. And they obviously have to deliver price action the most efficient way with the why and the how. That's it. Okay. So talked about it. Enigma can deliver price action however it wants. There are only a few limits in the system, which are, again, just talked about it. Average daily range maximum, timings of the sessions. Again, they have to be also aware of the session open times when liquidity enters to balance the liquidity. Fair price delivery, aka imbalance fills. The need of creating the build-ups. Again, they have to create the build-ups. They have to give people a reason. They will not play tennis with themselves and shuffle money around from banks to bank. It's not what they do. They have to give the majority of the world reasons to bring in liquidity. Now they take the money from them. Of course, it has to be like that. So they will always show the support resistance. They will always show the smart money concept. They will always show the trend line. That's just the principle of they have to create liquidity and then take it out. So you will always see a third touch of the trend line having a reaction. It will always be like that. It's a universal law in the market. It always have to be like that. But then guess what? They have to evolve emotions and feelings, aka FOMO, fear of missing out, with the vector candles and stuff like that. And they have to do everything fractal in terms of time frame. Again, the saying, one of my quotes is one of the best quotes there is like, people are stupid in all time frames. Again, there's a third touch of a trend line in the 1 hour is the same shit as a third touch of the trend line in the 1 minute. The M1 obviously brings in much less liquidity because less people see it, and the 4 hour or the daily time frame brings obviously more liquidity and has a bigger impact about the market. But the principle is always the same. That's why you technically can trade the 1 minute exactly the same as the daily if you really want to, but there's no point of trading the daily because you wait 2 weeks or 5 weeks or 5 months for a position to turn out. In the 1 minute, you have a 1 to 10, obviously, in a day. Right, it just makes more sense to naturally dig into the lower time frames because you have the same result in a much faster environment. The only thing is you have to do, don't ever trade the M1 alone. Always combine it with the M5, the M15, 1 hour, multiple time frame approaches. See where you are overall in the daily cycle variation, right? And they also will use London Knockout and Retail Heaven to move price in one direction some point. Again, it has to be like that. It has to naturally be like that. Price can't range always. That would be the case if you have like, whatever, London Cup trade here, then London Cup trade here, right? Then new London Cup trade here. Then it's sideways. But obviously at some point, price has to move out of the range, and they have to do it with either the London Knockout or the Retail Heaven. It has to be like this. Just be aware and identify those before, and then you're all good and prepared. Right? Then high liquidity zones, awareness that every cause or has its effect, and every effect has its cause all the time. It's always the same, and they balance the buy side and sell side liquidity at all times. Again, they do the same thing for the buy side, they do the sell side simultaneously all the time. And the moment they load the boat on into one direction, majority of the people are selling, then obviously they can drive price action in the opposite direction, take the liquidity, and that's how the market is engineered. So watch this video a couple of times so you truly understand what's going on inside the market and have this advanced way of looking at price action without everything else we learned so far over the 6 weeks, right? Massive information, but now that's the advanced way to do it, to put everything together and truly open your eyes and truthfully see what's going on, the who is it, what strategies are getting targeted, the where does it happen, the when does it happen, the why they're doing what they do, and the how they do it in terms of what they show also. And then combine everything on top, daily cycles, normal confirmations, the simplicity approach, entry helper, everything in combination, and then you will have the huge advantage over 99% of traders out there.